Welcome, students. This is Tom Harmer, your accounting professor, and this is another publisher's illustration of how to utilize the worksheet. The trial balance is being entered from the general ledger accounts, which they just provided up above, and then they're illustrating how we enter the adjusting entries and obtain our adjusted trial balance. Pay particular attention to the adjustments process and how we end up with the adjusted trial balance, because it's from the adjusted trial balance that we can produce our financial statements. So here we go with the presentation.
On January 31st, 2013, the General Ledger of parent company showed the following account balances. Prepare the worksheet through the adjusted trial balance section. We're to assume that every account has a normal debit or credit balance, and the worksheet covers the month of January. Cash, accounts receivable, supplies, prepaid insurance, and equipment are all asset accounts. Asset accounts have normal debit balances. We will include these as debits on the trial balance. The next account, accumulated depreciation on the equipment, is a contra asset account. Its purpose is to reduce the value of the asset. Since we reduce assets with credits, accumulated depreciation has a normal credit balance. Accounts payable is a liability. Liabilities sit on the right-hand side of the equation. They have normal credit balances. The rest of the accounts are subsets of equity. To determine whether they are normal debit or credit balances, we need to look at the impact each item has on equity. Parent's capital account increases owner's equity. It represents the investment by the owner. We increase equity with credits. The capital account has a normal credit balance. Fees income is a revenue account. It too increases owner's equity. Revenues have normal credit balances. The remaining accounts are expense accounts. Expenses decrease equity. Expenses have normal debit balances to show the decreased equity. When we total the unadjusted trial balance, $200,950 in debits and $200,950 in credits. Next, we begin with the adjusting entry information. Letter A. Supplies used during January totaled $4,650. The adjusting entry is a debit to supplies expense and a credit to supplies. Letter B. Expired insurance totaled $1,525. This represents the amount of insurance expense. The adjusting entry is a debit to insurance expense and a credit to prepaid insurance. Letter C. Depreciation expense for the month was $1,300. The journal entry to record depreciation expense is a debit to depreciation expense and a credit to the contra asset account, accumulated depreciation on the equipment. We total the debit and credit columns for the adjustments, $7,475 in debits and $7,475 in credits. We extend the information to create the adjusted trial balance. Cash is unadjusted. The balance in accounts receivable was also not adjusted. It stays at a debit of $20,400. Supplies had an unadjusted debit balance of $6,900. We credited the supplies account, reducing the asset by $4,650, resulting in an adjusted supplies balance of $2,250. Prepaid insurance, unadjusted balance $6,100. We reduced the asset, crediting prepaid insurance by $1,525 for a net debit balance of $4,575. The balance in the equipment account didn't change. It stays at the asset's cost, $89,400. Accumulated depreciation had an initial credit balance of 0. This tells us that the equipment was brand new. It has never been depreciated before. We recorded the first month of depreciation, crediting accumulated depreciation for $1,300, giving us an ending credit balance in accumulated depreciation, which is normal for a contra asset account, of $1,300. Accounts payable, capital, and fees income did not change in the adjusting process. The credit balances carry over to the adjusted trial balance column. depreciation expense had a beginning debit balance of 0. We debited the expense account for $1,300, resulting in an adjusted balance of $1,300. Insurance expense, 0 plus $1,525, is an adjusted debit balance of $1,525. Rent expense and salaries expense are unadjusted, and the balance in supplies expense went from 0 to a debit of $4,650. We total the debit and credit columns for the adjusted trial balance: $202,250 in debits and $202,250 in credits. The final step is to extend the adjusted balances to the income statement and balance sheet columns. Every account is only used once. Cash, accounts receivable, supplies, prepaid insurance, and equipment are all assets. Assets belong in the balance sheet. Accumulated depreciation is a contra asset. It too belongs on the balance sheet. Accounts payable is a liability. It belongs on the balance sheet. The capital account really belongs on the statement of owner's equity, but we include the capital and drawing account in the balance sheet columns. Fees income is a revenue account. It belongs on the income statement. And our expense accounts all belong on the income statement. We total the debit and credit columns for the income statement and balance sheet: $24,725 in debits, $106,650 in credits. Balance sheet total debits $177,525 and $95,750 in credits. We don't expect the debits and credits on the income statement or the balance sheet to balance at this point. That's because we need to calculate the net income. Parent company had net income equal to the difference between the $106,500 in credits and the $24,725 in debits, the revenues and the expenses. Net income is the difference, $81,775. We add this to the debit column, bringing the total debits to $106,500. Net income is transferred to the statement of owner's equity, which ultimately updates the balance in the capital account on the balance sheet. We debit the income statement columns and credit the balance sheet for the amount of net income, $81,775. Total debits to the balance sheet, $177,525, and the same amount for credits.
All right, there you go. That is the completion of the worksheet, and now the income statement can be prepared from the income statement section, then the statement of owner's equity, and then the balance sheet. So there you go. Good luck with your project.